regulations, and risk management in financial systems. 3. Actual operations. In practice, instead of signing agreements between two banks, different banks will sign credit default swap contracts with a large bank or insurance company. In the 2008 financial crisis, it was found out that AIG, a large insurance company, signed many credit default swap contracts with different banks and various investors. AIG was the financial institution that received most government bailout funds, about $150 billion. We will use some examples to show how CDS contracts are used in risk management practices. Example 4. A bank has $100 million capital. On average, bank assets will have 80% probability to generate a return of 0.125 and 20% probability to generate a return of negative 0.4 over 1 year period. The bank signs an CDS with an insurance company. When the bank makes a loss, the insurance company will make full payment of the amount of loss. The insurance company requires 10% profit margin over its expected payment. What is the expected payment from the insurance company? What is the insurance premium? What is the return on asset after CDS agreement? What is 1 year 5% VAR of $1 million asset for the bank after signing this CDS contract? If the regular system requires 1 year 5% value at risk to be equal to or less than a bank's capital, how much asset can the bank hold? What is the return on capital with this level of asset? What is the largest amount of loss bank will occur with this level of asset? Solution 1. The expected payment in a year for $1 million asset is 0.4 million times 20% probability is equal to $0.08 million. 2. With 10% profit margin, the insurance premium is 0.02 times 1.1. It is equal to $0.088 million for $1 million asset. 3. With this payment, there is an 80% probability an asset will earn a return of 0.125. This is the original return minus 0.088. This is the insurance premium equal to 0.037. There is a 20% probability an asset will earn a return of negative 0.088. This is the insurance premium because the loss is covered by the insurance company. The expected rate of return on assets after CDS agreement is 0.037 times 80% probability minus 0.088 times 20% probability. This is equal to 1.2%. 4. 1 year 5% value at risk of $1 million asset is $0.088 million. This is the amount of insurance premium because the actual amount lost is covered by the insurance company. The amount of asset the bank can hold is 100 divided by 0.088 is equal to $1,136 million. The return on capital is return on asset times leverage. This is equal to 1.2% times 1136 divided by 100. The result is 13.6%. This is higher than 5% return without CDS contract. With further refinement of CDS contracts, the return on capital can be higher. This will be discussed in the next example.
Example 5. A bank has $500 million capital. It holds a well-diversified portfolio. The profit and loss distribution of the bank's portfolio is 5% return with 90% probability, negative 20% return with 8% probability, negative 40% return with 2% probability over 1 year period. What is the rate of return on the bank's asset? What is the 1 year 5% value at risk of $1 million asset for the bank? If the regulatory system requires 1 year 5% value at risk to be equal to or less than a bank's capital, how much asset can the bank hold? What is the return on capital with this level of asset? What is the largest amount of loss the bank will incur with this level of asset? Solution 1. Return on asset is equal to 5% times 90% probability minus 20% times 8% probability minus 40% times 2% probability. The result is 2.1%. This is typical of return on asset for banking assets. 2. Value at risk for $1 million asset is 20%, equal to 0.2 million, because the cutoff of 5% is at negative 20%, because the negative 40% part is only 2%. So then we move further 3% to the loss part is negative 20%. So the value at risk is 0.2 million. 3. The amount of asset the bank can hold is the bank's capital divided by value at risk per $1 million asset. The result is 500 divided by 0.2 equal to $2,500 million. 4. Return on capital is equal to return on assets times leverage, equal to 2.1% times 2,500 divided by 500 equals 10.5%. 5. The largest amount loss is equal to 40% times 2,500. This amount of asset equal to $1,000 million. So this is twice the capital level. Example 6. Continued from example 5. Now the bank signs a credit default swap contract with a large insurance company. When the bank makes a loss in a year, the insurance company will cover the loss up to 20% of the amount of the principal. The insurance company requires 10% of profit margin over its expected payment. What is the insurance premium? What is 1 year 5% value at risk of $1 million asset for the bank after signing this CDS contract? If the regulatory system requires 1 year 5% value at risk to be equal to or less than a bank's capital, how much asset can the bank hold? What is the return on capital with this level of asset? What is the largest amount of loss the bank will incur with this level of asset? Solution 1. Insurance premium is equal to the expected amount of payment times 10% profit margin. So it is equal to 20% times 8%, that's the loss for 20%, plus 2%, that's the loss for 40%. So together, the possibility of loss is 10%. However, the payment is not of all the loss, but up to 20% of the principal. So it's times 20%. The expected loss up to 20% times 1.1, and the answer is 2.2% of the principal. 2. Since the insurance covered the loss of bank's portfolio up to 20% of the principal, the loss of the bank at 5% level is the amount of CDS premium, which is 2.2%. 3. At a 5% cutoff, the loss is at 2.2%. So 5% value at risk of $1 million asset is 1 million times 2.2%. It is equal to 0.022 million. 4. The amount of asset the bank can hold is equal to the level of capital divided by $1 million VAR. So it's 500 divided by 0.022. The answer is $22,727 million. 5. Return on asset after CDS payment is 5% times 90%, because this when you make a positive earning, nothing changed. And when you make a negative return up to 20%, the insurance company cover all the loss. But in the case the 2% probability the loss is 40%, the insurance company only cover 20%. So there's still 20% loss. And finally, whether you make loss or not, you have to pay 2.2% premium. So you have to minus 2.2% premium. And the answer is 1.9%. So you see, the return on asset after CDS payment is 1.9% instead of the original 2.1%. 6. Return on capital is equal to return on asset times leverage. It is equal to 1.9% times the leverage is 22727 divided by 500. It is equal to 86.4%. 7. The largest amount of loss is equal to the amount of asset times the amount of loss per $1 million. The amount of loss per $1 million is 20%. That 20% is the amount of loss not covered by insurance, plus 2.2%. This is the insurance premium. Altogether, it is equal to $5,045 million. So this amount is about 10 times the bank's capital. So it's much higher than the bank capital. Comments. Credit default swap contracts are insurance contracts. With credit default swap contracts, return on capital increased to 86.4% from the uninsured 10.5%. The largest amount loss increased to $5,045 million from the uninsured $1,000 million. With insurance, the return on capital increases. At the same time, the largest amount of loss increased substantially with insurance. This is because leverage can increase substantially with insurance. The last part of the lecture is the theory of regulation. From the mainstream economic theory, unregulated free markets are usually optimal. Regulation is warranted only when the market is imperfect. With time and effort, the financial market will become more and more perfect over time, at least in the developer market. 2008 financial crisis was a surprise to many people because they think developed markets are very close to perfect market. On the concept of perfectness, different players in a system have different interests. A system that is better for some players will be worse for other players. There's no such a thing called perfect market. The actual social structures are determined by the power balances among different players in a system. Analogy to biology. The situation in economic theory is analogous to the state of biology before Darwin. In the old system, each species was imagined to have been created according to some ideal type. Variation was just so much noise superimposed on the ideal type. After Darwin, the variation itself was seen as real and important, while the notion of an ideal type was recognized as a useless abstraction. Robert Trivers, 1985. Regulations in organisms and organizations. All organisms and organizations regulate their internal environments. Many also regulate their external environments. In general, higher organisms and organizations regulate their internal environment more precisely, with higher resource expenditure, than lower organisms and organizations. This does not mean more regulation is better. Higher organisms are not necessarily better than lower organisms. Each type of organism adapts to local environment at the moment. The evolution of regulatory processes. Regulatory processes, like all other biological and social processes, are evolving all the time. Some regulations are initiated to stabilize financial systems or to protect the general public. Other regulations are initiated to restrict further entry to protect the existing players in the field. Interests of the industries are more concentrated. The interests of the general public are more diffuse. The industries have greater incentives to influence the regulatory systems than the general public. Over time, regulations generally evolve to serve the interests of the industry themselves instead of the general public. Two examples of the evolution of regulations. First, deposit insurance. The original purpose of deposit insurance is to protect unsophisticated small depositors. Over time, it evolved to protect sophisticated large market players in the financial institutions. This insurance bailed out large financial institutions engaging in highly leveraged businesses. 2. Value at risk. It evolved from a risk management tool into a profit-generating tool for financial institutions. Gradually, the measurement of value at risk masked the true risk of the financial institutions. Some examples of regulatory systems. In the following, we will discuss some examples of regulatory systems. These examples will illustrate the dynamic nature of regulations. Immune systems. Immune systems aim to regulate internal environment. They attempt to recognize and destroy invading microbes and other foreign substances. They attempt to destroy internal but malfunction parts, such as cancer cells. At the same time, they try to avoid attacking their own tissues and organs. At the same time, microbes evolved to evade attacks from immune systems. Perfect market is never achieved inside human body. Immune systems always have to change to respond to outside changes. Similarly, optimal regulation in financial market never exists. Operators' activities will change according to regulations. Clever invaders often mimic the structures of the cells of the host. Similarly, the best way to rob a bank is to own a bank. William Black wrote a book in 2005. The title of the book is called "The Best Way to Rob a Bank is to Own One: How Corporate Executives and Politicians Looted the S&L Industry." The next example is about the relations between mammals and grasses. Grasses first appeared on the Earth about 60 million years ago, around the time when dinosaurs went extinct. The extinction of dinosaurs provided mammals with wide open ecological niches. Mammals multiplied rapidly. Since mammals are more active than reptiles, they disturb the landscape more. This makes the environment more hospitable to fast-growing grasses than slow-growing trees. In the past 60 million years, grasses have spread very fast and now are covering approximately 20% of the Earth's land surface. If our speculation is true, then mammals have played an active role in regulating the environment to benefit the spread of grasses. This in turn benefits the spread of mammals. Humans and grasses, all food crops such as wheat, rice, corn, millet, are grasses. All vegetables are grasses. Lawns are grasses. Human beings actively clear forests. We contribute to the spreading of grasses. We continue a trend that has lasted for more than 60 million years. Health of individual and health of a system. In life, no individual lives on forever.
Instead, new life replaces old life. In human societies, no one lives on forever. The health of society depends on the birth and growth of new life. We can rejuvenate a society only if we have many juveniles. In financial system, when dominant financial institutions receive too much government support and protection, the birth and growth of new financial institutions are stifled. Health of individual institutions is not equivalent to the health of financial system. Games between regulators and market players. The stated purpose of regulation is to make the financial market stable. The purpose of market players is to obtain high return for themselves. Management and investment strategy evolve with regulatory systems. There is a parallel between pollution and financial risk. The solution to pollution is dilution. In chemical industry, factories are often built by rivers or lakes. Pollutants can be diluted into the water easily. The solution to financial risk is dilution. In financial industry, assets are securitized. They are distributed to the public. An example of asset securitization is the securitization of loans, such as mortgage-backed securities and credit card and other payment-backed securities. These securities are widely distributed to the public. There is a parallel in results. Dilution increases the total amount of pollution and the total amount of financial risk. Finally, we will discuss social science as a precise science. In times of financial crisis and monetary losses, it is often said that social science cannot be as precise as science. So we will look at an example of science. If you climb up a playset, you may find signs like maximum capacity 150 pounds. Does that mean if you are 151 pounds, the playset will collapse? The playset can support at least 500 pounds, several times the capacity requirement. Engineering projects usually have large margin of safety. The following is a quote from Cannon's book, The Wisdom of Body. When an engineer estimates the weights which a bridge or beam must support, or the pressures to which a boiler will be subjected, he does not provide merely for those stresses in building the structure. The engineer multiplies his estimates by 3, 6, or even by 20 in order to make the structure thoroughly reliable. The greater strength of the material, above that calculated as necessary, measures what is known as a factor of safety. In financial institutions, capital adequacy ratios based on Tier 1 capital equity may be 4%. Capital adequacy ratios based on Tier 1 and 2 capital equity plus long-term debt may be 8%. Will most financial institutions provide 16% capital adequacy ratio, doubling the minimum requirement? The above example shows that social sciences and science do not differ as much in their precision as in their treatment of factor of safety. Why the differences? If a company tried to save materials from playsets or bridges, they could get at the most millions of extra profit. If a playset or bridge collapsed and some people got injured or dead, probably the company will get out of business and the managers will get into prison. If a bank lowers its factor of safety, it can make billions of extra profits. If a bank faces collapse, it is often bailed out by the government, and no one is charged even when there are multi-billion losses. If the society demands bank operations as safe as engineering projects, bankers probably can earn only as much as engineers. The income from profession is largely determined by social attitudes. Possible presentation topic: discuss an example of dynamic behavior caused by regulatory activities. For example, the bailout of long-term capital management in 1998 by the Federal Reserve may encourage more leveraged trading. This generated larger-scale financial crisis in 2008.